Okay, so some of the absolute sharpest minds in finance are all looking at Bitcoin's future. And believe me, they are not seeing the same thing, not even close. One expert sees a $250,000 asset, while another sees it really struggling to hold its ground. In this explainer, we're going to break down this huge disagreement and try to figure out who might actually be right about 2026. I mean, the sheer disagreement over Bitcoin's 2026 price is just staggering. Just look at this spread. On the one hand, you've got academics like Carol Alexander who are predicting a pretty volatile range, somewhere around $100,000. But then, on the complete other end of the spectrum, you have industry pioneers like Charles Hoskinson talking about $250,000. And right there in the middle, you've got the big banks like Standard Chartered targeting about $150K. So you have to ask, why the enormous gap? This isn't just random guessing or people throwing darts at a board. What you're seeing is a fundamental conflict between two very different ideas about what Bitcoin has actually become, and whether the old rules of the market even apply to it anymore. Let's start with the optimistic argument, the bull case. And really, it all hinges on one incredibly powerful idea: a tidal wave of institutional money that is finally being unleashed. $50 billion. Remember that number, because it's the key. That's what Galaxy Digital is predicting could pour into US Bitcoin ETFs alone. I mean, to put that in perspective, that is a colossal amount of new capital, all chasing a very, very limited supply of Bitcoin. And let's be super clear here. We're not talking about you and me buying a little bit here and there. This is large-scale capital. We're talking asset managers, major banks, the real heavy hitters. These new ETFs have basically opened up a regulated, easy-to-use gateway for a whole new class of conservative, deep-pocketed investors who, up until now, were pretty much locked out of the game. So the bull case really just boils down to classic supply and demand, right? The theory is that this new, steady, institutional buying is going to be so strong that it just soaks up all the available supply. You have firms like Bernstein and Fundstrat, and they see this pushing prices way up toward $200,000. They're basically arguing this could finally break Bitcoin's traditional 4-year cycle, the dramatic peaks and valleys tied to its halving events. This could change everything. Now, that sounds like a sure thing, doesn't it? A flood of new money, a limited supply, prices should just go to the moon. But, well, that's not what everyone is predicting. The other side of this whole debate sees this institutional flood not as a guarantee, but as the biggest variable of all. And nothing illustrates this uncertainty better than Standard Chartered's own forecast. Originally, they were targeting $300,000 for Bitcoin, but recently they cut that prediction in half, all the way down to $150,000. And the reason they gave? Institutional adoption just wasn't happening as fast as they'd hoped. That's a huge shift. So this brings us to the bear case, and it argues that all this new institutional interest, it isn't a safety net at all. In fact, it's a high-stakes gamble that could actually make things much, much worse. And look, this isn't just a gut feeling, it's based on data. The analytics firm CryptoQuant pointed to on-chain indicators, we're talking about the actual transaction data on the blockchain itself, to argue that Bitcoin was already showing signs of a bear market regime in late 2025. It was showing weakness before the year even got started. And right here, this is the absolute heart of the disagreement. The bulls, they see institutional money as sticky. They think these big players will hold on and buy the dips. But the bears, they believe this new money is flighty and super price sensitive. They're predicting it will flee at the first sign of real trouble, which would make any sell-off way more severe than anything we've seen before. The bearish view then is that all this ETF hype is just a temporary sugar rush. They see these warning signs in the on-chain data, and they think that Bitcoin could once again get tied to broader economic conditions, things like interest rates and inflation. And that's exactly why the more conservative forecasts keep Bitcoin well below that $200,000 mark. Okay, so we've got the powerful bull case on one side and the cautious bear case on the other. So what's the verdict for 2026? Well, the only honest answer is profound, massive uncertainty. When you lay all these forecasts out side by side, the division just becomes crystal clear. You've got JP Morgan using a gold-based model to land at $170,000. Bernstein is targeting $150,000, betting that institutions will stabilize the price. The thing is, everyone has a sound thesis, but they all arrive at wildly different destinations. So at the end of the day, the real story for 2026 isn't about hitting a single price target. It's about this intense battle between two powerful forces:
You've got the unprecedented new demand from Wall Street versus the historic, wild volatility that has always been baked into Bitcoin's DNA.
And this is it. This is the crucial question that's going to define Bitcoin's next chapter. Will the relentless buying from the world's biggest financial players finally tame Bitcoin's wild nature? Or will the fundamental risks of this market prove that even Wall Street can't change what Bitcoin is? The answer won't just determine a price. It's going to determine the future of the entire asset.